Welcome everyone to the Kendall Report, where I share my 40 years of experience to help you manage and protect your wealth. Don't forget to subscribe, hit the bell, and share these videos. Thursday's activity was much better than Wednesday as we saw a recovery. As I discussed with you last night, I believe that crude oil would be the driver of the markets moving higher over the next several days. I did not know that the president was going to work a deal with the Russians and Saudis to cut significant production. This set the tone for a positive across the board in the markets. Even gold was able to rally on this. The disappointing thing that came out of yesterday is we're starting to see the stress that's coming out of the economy. Unemployment claims showed 6.6 million new claims, 3.3 million last week, so 10 million people are out of work in 2 weeks' time. This is a phenomenal increase in unemployment like we've never seen before, and this is just the beginning. I believe a lot of folks may have been kept on just until the first of the month, and many people being furloughed as we move forward over the next several weeks. We're going to see even more reflection of the carnage that this stoppage of this economy is having. There's no way to escape. We did have a chance at a V-bottom that the president thought we would get, and he wanted to get us back to work today, April 2nd. That didn't happen, so this carnage is going to continue. Some of the other areas of stress that are already showing up, there have been capital calls on a couple major mortgage players suggesting that they are already out of liquidity in 2 weeks' time. There's a new Moody's report that's out. I will go through with you later to show you some of the charts, but the spreads are blowing up and a lot of other elements. I'll go through that in detail shortly. This being the end of the week, we've got employment numbers coming out, which aren't going to be material at all. No one cares. They're for January. Everything was fine in January. What we're going to be looking at is all the numbers going forward and the expectations of what's likely to happen. One of my concerns, because it's the end of the week, is that many traders may not want to stay in for the weekend, so we may see some liquidation. Today's activity on Friday will be important to next week and beyond's activity. We're at that critical point where if certain things don't happen just right, that we could get a failure and we could see the lows taken out that were made 2 weeks ago. I've also discussed in the past these ways of unexpected returns, or the old shit moments. I didn't think of this happening, didn't think of that happening. Those are going to show up big time in the next couple weeks. The Treasury, the Federal Reserve, and the SBA is trying to get kinds of loans out to help people with payrolls because they know everything's disrupted. Now that strategy in itself might plug some holes and maybe keep the claims down over the next couple of weeks. We'll have to see how that plays out. But many of these employers have already failed financially. Not everybody has a lot of reserve capital, and reserve capital is disappearing very quickly. And for what I understand about these SBA loans, they're not as simple as the Treasury Secretary and the head of SBA is saying they are. Chase Bank website blew up today, everybody trying to get in to make applications. So it's very complicated. They're doing large webinars. They're even crashing. There's so many people in need. There are millions of businesses that need this help. So these are some of those things that I'm talking about. It's going to be very difficult going forward, just trying to get through that rotary door. Somebody's yelled fire, everybody's trying to get out the same door, and it's not very big. So things will get uglier as we go forward. We've got a lot of work to do, as I talked about last night. Right now, the technicals are leading the fundamentals, but today's activity possibly tell us whether that's even going to work. First, let's go and review the stats in the Moody's report, and then we'll go into the technicals. This is a chart from the Moody's report showing how the basis point spread has increased. You'll notice here where my cursor is in 2009, the shaded area was the Great Recession. You see that we shot up to about 375 in early 08. We're already at 423 in 2 weeks. This took In '07 to '08, took nearly a year to get to these levels. And of course, after Lehman failed, we saw this big spike up to 725. But these are huge numbers that are suggesting that things are getting bad really quickly. The second area of this report I want to focus in on is the rating changes in corporate and financial institutional debt. This reflects exactly what's going on. Every one of these have been downgraded. I'm not going to talk about any specific company, but I'm going to scroll through these pages so you can just see how the D stands for downgrade. That's in this column here. It just continues. Everyone is downgraded. Nothing has went to junk yet, but they're pretty close. CAA3 is darn close. And this chart here actually reflects the spreads on global data, and you can see the spike here is also equal to or above where we got to in early 2008. And I've been talking about the Bear Stearns moment. We were at that point that possibly these strategies that the administration, Federal Reserve, SBA, and everything they're trying to do could get that reflection point where we see some stability and the markets stabilize. But everything is accelerating way faster. The spike that you see on the far right here is actually in literally 2 weeks compared to well over a year back to mid-2007 to the first quarter of 2008. These are 2 to 5 year medium spreads, the same spikes you're going to see in these charts. The CDSs are also seeing downgrades. Everything is getting worse across the board, and rating agencies are freaked out like everyone else on this planet that they might get something wrong and get beat down like they did in 2008. So they're being very aggressive with these ratings. Once again, I'm going to utilize the futures contract to take a look at this market. This is one of the more interesting configurations I've seen for a while, where typically when moving averages get in this position, they usually don't get this tight together like the 10 and 21 is, and especially they're conflicted. The 10 period moving average is rising at 0.79, while the 21 period moving average is declining at 0.97. So both of these reflect substantial trends. One down, one up. The 21 is down, the 10 is up. The question is which one will win, and typically in this situation, the 21 is going to win. So this tells us that we may not be able to get above that level, which is 25.36. That's on the futures. I'm going to bring up the cash for a minute so you can see where that is. That number here is at 25.77. So we're trading at the close yesterday at 25.26. So that would be up 50 handles or about another 2%. The way markets are trading right now, that doesn't look very possible, but we have been getting about a 100-point range. This 100-point daily range is half of what it was just 2 weeks ago. It's hard to believe that 100 handles in the S&P is likely within one session, and it starts to feel like volatility is dropping. We are seeing some things that are starting to lean towards more stability and further advances. All expectations are for a continuation of the upside, and today will be critical. Where we close today will indicate how early next week's going to trade and the potential whether we will fill the gap down at the 2300 level or whether markets will hold here and move up to 2900. So we're literally at one of those pivot points. And it seems ridiculous. If we close lower, then we'll continue lower for a few days, potentially challenge the low that we made at 2191.86, which is a long ways from here at 25.26. But that wouldn't happen until next week. So this is not for Friday, but it is for the next several days, depending on how we close. So if we close below 28.84, we're going to see the potential for a move down to the 23, 21.91. I've drawn this configuration several times, but one quick draw in just so you remember what this pattern is likely to look like. We'll confirm this pattern. And more importantly, if we can close above 25.77, then it will be a guarantee that we will move to 28.55 to 29.20 over the next 5 to 8 sessions. This would confirm this pattern, and then the next pattern would be a pretty massive decline back down. Quick comment on the treasuries. I believe yesterday was most likely the low. We should see a move back toward the 0.7 level and the possibility of moving up to 0.75 over the next 2 sessions. It does appear that the support is at 0.60 and the resistance at 0.75. The gold market rebounded sharply. We are hovering just above the 10-period moving average. It does have a substantial upslope, which suggests we could continue to move along that line. The pivot point is at 1650, and then the next target is 1661. On the downside, 1614 looks like to be the major support. The PPMs are suggesting that there's a potential top, and there could be another leg down, testing the 1580 level, and the possibility is going as low as 1528. I mentioned in the opening comments that crude oil is likely to be a driver. The configuration suggests that we will trade between 22.50 and 26.54. We should see further move to the upside. We are seeing quite a bit of pressure overnight, down 4.50 right now, back to 24.28. We did see it get as high as 27.30 yesterday. This is going to be a consolidation. PPMs are all turning. We're likely to see a continuation. Don't see us getting much above 28.50 at this time. Expect crude oil to remain between 22.60 and 26.50 with the extreme of 28.50 on the upside. This will complete the broadcast. Thanks for watching. We'll talk to you on Sunday night.